All right, welcome back, people. Today I got Scott Carson with me. He is into note investing, something I know nothing about, so I'm going to learn a ton today. Hopefully, you guys learn a ton as well. Scott, for our audience, could you give us a little background, a little synopsis of who you are, what you're doing, and how that relates to commercial real estate?
Sure. Glad to be here today. First and foremost, honored as always. And if you guys are here listening, make sure you hit that subscribe button, leave a 5-star review right now. We don't wait till the end. Let's do it right now. But I'm out of Austin, Texas, and I'm known across the country as the note guy. And I got started like many people in real estate. I read Rich Dad Poor Dad. But I actually went and bought a rental property or two and fell flat in my face. Started to get into following Ron LeGrand and some other folks and started diving into doing real estate the right way of investing. And I had a mentor, a guy by the name of Bob Leonardi, named Jamie Kalo, that I worked with for about 4 years doing mortgages. I was originating mortgages on residential commercial properties for real estate investors all across the country. And they had kind of taught me the note business. They were not only on the residential, but the commercial side. And when everything hit the fan in 2008, I saw an opportunity instead of where everybody was struggling and losing houses and foreclosures and stuff like that. I went the route and started buying debt instead of properties. And so I started buying distressed mortgages on residential and commercial properties, multifamily stuff, and strip malls, and you name any type of commercial or residential asset, I've bought a mortgage on it at some point and either held it or worked it or stuff like that. But that's what I've done the last really 15 years is hang my head on just buying distressed debt here in the United States in about 20 to 30 different states. I get my stuff direct from banks on a regular basis so that I can cherry pick. I don't have to buy everything. Anywhere, we're here to talk about commercial real estate. So anywhere, like I just got in a list of notes of some small balance multifamily stuff, anywhere from a fiveplex in Chicago all the way up to about a 100-unit apartment complex in Indianapolis. I like being the bank. I do this from anywhere in the country. I don't necessarily want to own real estate, so it's a little bit of a different mindset being the banker versus the actual property owner. But I love it, man. Bought over $1 billion in debt, and I'm very, very excited with what's going on in the market when many people are scared right now.
Love that. So you started actually flipping homes, and then you went to the origination side of it, and then that's when you started to buy notes based on essentially from mentorships, learning how to do it, right? So for any of us who doesn't know what a note is, could you explain to us what that really is?
Yeah, sure. It's easy. Everybody's already in the note business. They're just on the wrong side of the payment streams most of the time. So if you've got a mortgage on your house, or you've got a car note or student loan debt, or you owe Capital One or Visa, you've got a note that you're just making payments on. And what I'm talking about a note, I'm not necessarily talking about like most people when they hear about the note business, when they think of real estate, they think about, oh, you're going to go own or finance a property. You're either going to sell on terms or buy on terms. You're going to create a mortgage. And that is one niche of kind of note investing. I'm a little bit different. I'm only one of like 3 people in the country that teach this, but what I do is I buy mortgages direct from the lenders. And so when I buy that mortgage note, usually the borrower hasn't paid in 6 months to 6 years or longer. It just varies a little bit. And so when we buy that note, I don't own the property. I'm literally becoming the lender is the best way to look at it. We're taking over the lending side of the business. Now, a lot of people are like, well, Scott, don't you want to buy the real estate? And I'm like, well, no. Now, while I'm buying this, I don't know if you guys can see this, but your video can. So I'm holding a collateral file. This is a note. This is a mortgage doc with all the different information in it that I do for due diligence. But when I bought that note, I now became the bank, and I can modify the loan of the lender. I could try to work out payment plan for them. I have all the same exact rights the lender does. And if the borrower doesn't pay, they stay. You know what I mean? But my biggest goal isn't necessarily to take property back. About 70% of the time, we're actually able to kind of work out a payment plan with the borrowers. If you think back to what happened in COVID, a lot of people stopped paying because they were out of work and had to work from home, and the government went in and said, oh, you can't foreclose. That was a time that was a little tricky for me, but we still had about 80% of our borrowers paying on time anyway. So when we buy the debt, yes, it does. We could technically foreclose if the borrower won't play ball with us, take the property back, but that's actually 70% of the time I actually like to just hold for payments, because if I can get the bar back track working, it's cash flow for me without having to rehab the property or foreclose or deal with toilet stints and trash outs, which I hate doing. Does that make sense?
I hear you. I hear you. I was in residential for a while, so I know exactly what you mean. Let's rewind a little bit to the first note that you ever closed. Could you walk us through that? What did that look like, and what lessons did you actually learn from it?
So let's talk about the first one I ever bought. You want to do a commercial or residential? Because they're both
Let's
a
do
little bit different.
commercial.
Okay, so commercial. So I'd already been flipping and wholesaling some residential notes from like Banco Popular on like property in like, Detroit for $500 or, wholesaling a note here and there. But I started, it's a kind of a funny story. I was targeting a 4-unit strip mall here in Austin, Texas, where I live. I'm like, man, I really want that. And I was making an offer. And then I find out from the listing agent that the note had been sold. I'm like, okay, mortgage was sold, and they worked it out with the bar. The bar didn't have to sell anymore. So I jumped on the county records and I tracked down that it was Greenpoint Mortgage that held the note, which is Capital One's commercial lending side. So then I started dialing for dollars, calling, like trying to get a hold of the right person in the right bank at Capital One. And I track all my phone calls, my call blitzes. So it was like 70 phone calls I counted up over 3 weeks of dialing, getting transferred. Eventually I got a hold of the right person, this lady named Amy out of New York. And she's like, yeah, we'll sell some more notes. I had to sign a non-disclosure agreement. And she sent me this PDF spreadsheet. And I still have it. I saved this 33-page PDF with all of their stuff that's under $1 million balance of commercial stuff all across the United States. It was like in 3-point font or 6-point font. I couldn't hardly read it. I had to get like a magnifying glass to read it. And on it, I see this 8-unit apartment complex in San Diego, off of Abrams Street. This is a street, just a small apartment, small single family, like duplexes, 4plexes, 8plexes, near San Diego State area. And I was like, okay. Well, first of all, I can't buy all of these. And Amy's like, no, just buy one. Just buy one, okay? So give you the numbers on it. The value from the bank was at $750. It's what they figured as far as appraisal. This goes back a few years, obviously. It was fully occupied. Borrower hadn't paid in over a year. Why the bank hadn't started the foreclosure process, I don't know, but they were too busy with the bigger stuff, if that makes sense, okay? Borrowed $548 and some change. They were willing to sell the note to me at $375 at a sizable discount for what's owed, but really just over 50 cents on the dollar of value at the point. And so I get this under contract. I'm like, great, but I don't have the $375, right? And I asked for 60 days. They gave me 45 days for due diligence and closing because I was buying the note. I'm like, okay. So I just started marketing. I mean, I did an email blast at my database. I started calling my friends in San Diego in the real estate. Ended up flipping that note on that commercial 8plex for a quick 35 grand profit 2 weeks later. You know what I mean? And he was happy. The guy that bought it, Matt Harder, he was happy. He ended up getting a full payoff from the borrower 9 months later at $548. So he was pretty stoked about it too. Of course, if the borrower hadn't played ball, he would have foreclosed, and then he held an 8plex that was worth $750 and more. I look back at now, it's like a $2 million, $3 million property, 15 years later. But hey, 35 grand to me back then was big money in 2 weeks. You know what I mean? And we've done that a lot of times. That was a $1 million relationship with Capital One because that we went on then to buy a 300-unit apartment complex in Indianapolis that we sold. We took a 21-unit back in Houston that we regentrified. We bought an 8plex in West Palm Beach that we took over receivership and then sold it at auction. And so that's one of the great things that I love about the note business is I don't necessarily have to go out and chase deals. Banks send me lists, or they send us lists on a regular basis that we can cherry pick from most of the time. And but that's the great thing is we get deals in. We know they're motivated. We get a lot of information from the bank and the lender, and then gives us an opportunity to really make a great return without having to actually own the property management, if that makes sense.
Yeah, definitely. When we're looking at notes, it's obviously a lot different from your traditional real estate. It's not the building, it's not the land. It's a piece of paper from a lender to a lendee, right? It highlights all the terms there. And it's also untraditional that you don't have kind of like an MLS to look for deals, right? So, and you kind of alluded to this, that to find these deals, you kind of have to build up a relationship with these banks, and you kind of have to build up your database of all these lenders. Would that be the correct assumption?
Yeah, it's just like anything else. I mean, if you wanted to get into buying apartments, who are you going to start reaching out to? Apartment realtors, right? starting joining apartment groups. That's what I had to start doing, was reaching out to bankers and finding the right departments. If you're on LinkedIn right now, you could literally go over to LinkedIn and type in like whole loan trader, and it'll pull up a list of people at different institutions that sell loan portfolios, or special asset manager, or secondary marketing manager. Those are the department names that these big banks have. And they even like commercial special asset manager. So like when I contact the bank, first of all, I'm looking on LinkedIn for a right person. Like, let's just say Bank of the West special assets manager. Well, I know that's Dana White, not the guy that works for, as an Ultimate Fighting Championship. It's actually a lady named Dana White, right? And I've known her for about 10 years, but I was able to call the main switchboard, main corporate office of Bank of the West, and say, hey, who's in charge of your special assets for your commercial notes? And they put me through to her. And now Dana sends me a list of everything that Bank of the West has once every quarter. And we buy some stuff. Sometimes we don't buy. It just varies. But yeah, it's all about doing, but it's a whole lot cheaper leveraging LinkedIn or jumping on some of these different servicing websites versus dropping thousands and thousands and $1,000 in direct mail campaigns. A lot of investors do. You know what I mean? One big caveat is we're looking in about 20 to 30 states. So you have to expand your network and your mindset that way versus just focus on like your own backyard. So there's a couple of big differences for you.
Gotcha. So let's go into the little bit of the nitty gritty. For someone who's like new to note investing or knows nothing about note investing, can you break down the general 30,000 foot overview process of buying a distressed note from a bank? Obviously, first off, you got to have that relationship via LinkedIn, cold calling, direct mail, etc.
No direct mail. We're gonna kill.
No
We're
direct
gonna
mail.
kill direct mail here. We're not gonna kill Amazon for us with this. Okay, we're gonna do it all. It's the 21st century. You're gonna be a real estate investor in the 21st century. Let's work smart. So leverage LinkedIn, leverage some tools like Dripify or Octopus to automate your connection requests with these asset managers and find it, because that's what it comes down to. It's just literally like shooting a shotgun against the side of a barn. Further out, I'm gonna have a lot more opportunity versus trying to just one bank at a time. So when you get in, and I'd always help folks start off with buy a residential note. It's basically the same process of buying a note, whether it's residential, commercial, so you don't have a lot of money involved and get the ball rock and rolling. Yes, you can cherry pick residential notes too. But when you get in this list, this Excel spreadsheet, they call it a tape, you're going to look at the areas that you like. You're going to look at your property types. You're going to look at, what I look at is the property, or is the property occupied first and foremost? Is there any cash flow coming off of it as far as mortgage payments? If there's not, is it occupied or vacant? What kind of condition is the property in as far as kind of value? The great thing about buying notes too is that we kind of see beneath the kimono, as I like to say, is that we're getting these servicing notes from the actual bank, so we can see if the borrower has been friendly, or if the borrower's been trying to do a workout program, or if the borrower told the bank just to go pound sand and F off. We know that on the front end side. So that works well. And then it's all about looking at not only the value of the property, condition of the property, but then looking at, two, the borrower, if it's an LLC or a person, what's their credit worthiness, what's their payment history been like, what did it look for? And then, of course, then we dive into the actual collateral file, or all the documents there as far as like the mortgage, the note, any assignment of mortgages. Has it been sold 2 or 3 times? What happened with the sale? And then if it's already in a legal process, foreclosure, which varies state by state, we'll actually speak to the attorney who's handling that file and saying, hey, how long do you have to foreclose? What's been going on? Has the foreclosure process been started? Why hasn't it been started yet? And every state's a little bit different. It's like Texas, we can do things faster in 30 days. Whereas if you try to foreclose in New York State, it's like 3+ years. So we avoid the longer foreclosure states, if that makes sense to you. But then it's, you're evaluating the risk. Let's just use some simple numbers. The note's non-performing on a property, and let's use simple numbers. Say the value's $200,000. They owe $210 or $220 because they haven't paid in a while. But if I can go in and buy that note at 50 cents on the dollar and pick it up for $100, that gives me a lot of flexibility to make money on this. So if it's like say a 7% interest rate on that mortgage note, well, if I'm buying that note at 50 cents on the dollar and I can reach out to that borrower and say, hey, just start paying on time again. I know you're behind by 2 years or 3 years or COVID, but can you start paying on time again? If they start paying, that's a 14% cash and cash return to me right off the bat. If I get them to bring some skin in the game, some back payments a little bit, not the full like 2 years or 3 years, that could really easily shoot me up into high double digits, if high teens or 20% or greater. And that's a great thing. Now, if they won't play ball, I foreclose, and now I can sell an asset at the foreclosure auction for under 200. I'm into it for 105, 110 with legal costs. There's plenty of meat there for me to sell at the foreclosure auction. Or if I do want to own that asset and add it to my portfolio, I'll just take it to the foreclosure and do a full credit bid. Nobody's going to pay $212 for a $200,000 asset, right? So now I own that asset and can operate it and do what I want with it. I prefer to get borrowers back on track, because if they make 12 months of on-time payments, that asset, that mortgage note, is now considered reperforming. I could then turn around and sell it back to Wall Street or other investors at 80, 90 cents on the dollar. If I bought it for 100, I get a year plus of payments, and now I can sell around and sell it at 180, 190, 170. That's a pretty good ROI without having to do any operations or fix and flips or stuff like that, if that makes sense.
Yeah, absolutely. Now, the first thing you mentioned is that you're in various states, like 30 of them, right? Now, one of the things you look for is the condition of the property. Do you fly out there to go visit the property, or you just kind of do do you have boots on the ground to check it out, or what's your process there?
So when I get a listing, I don't ever drive by a property unless it's like locally here. I'm in Austin, Texas, so within an hour I'll drive by. But most of the time, I'll just look at online information, because the great thing about bidding on a note is the bank knows you're not going to be able to fly out and go look at all 30 properties, right? So what I'll do is look at the online values that we can find. Yes, we'll use that hated website LoopNet or Zillow, Google Maps, just to get a feel for things, because usually there'll be the original appraisal in the file. And we'll make what's called an indicative offering, knowing that if our bid's accepted and we are in a true due diligence period, we're going to have time then to send an agent or boots on the ground out to drive by the property, take photos. If it's a sizable chunk of asset, I'll jump on fly out and walk it too if we need to. But we've bought, I've bought thousands of residential deals that I never even looked at myself. It was always realtors, pulling a BPO and taking photos for me. Your commercial assets, you can do a little bit of that, but you all and I both know, like, you're buying a multi-family apartment deal, you want to definitely go out and probably walk it in a lot of cases. You want to, depend on, especially if it's vacant, you definitely want to get out and walk it and see what condition. But if it's occupied and there's some sort of payment history or depending on how friendly the borrower is, you can often get away without having to do any of that.
Certainly. And now you've mentioned that, some of these notes you're buying for 50 cents on the dollar, right? And then you can either restructure it in some way or take over ownership and then resell it for 80, 90 cents on the dollar. From the initial conversation that you've had with the original lender on the note, what is your conversation like with them in order to purchase this note for 50 cents on the dollar? And I know you mentioned a couple of bidding scenarios and whatnot, but do you kind of just negotiate with them, or what does that look like?
So I'll give it a great example. I was buying a 12-unit apartment complex in West Palm Beach back in the day. And the lender actually called me from a referral from another banker. And he wanted like 90 cents on the dollar. It was 1st of October. I'm like, I'm not paying 90 cents on the dollar for a non-performing note. Not going to do it. I'll give you 70 cents on the dollar for this one. Oh, no, I couldn't take that. I'm like, okay, fine. So 30 days later, I called him back up. Hey, man, have you sold that note on that West Palm Beach? No, man. I still got it. I said, well, my 70%. Oh, no. We can only go like 85 cents on the dollar. I'm like, nope. Same thing. Sometimes deals take 90 to 120 days of follow-up and just following up. Because here's the thing. There's a lot of bankers and asset managers smoking a lot of wacky tobacco crack out there right now. They think their asset's worth one thing. They got their head shoved so far up there. You know what I mean? They don't make any sense. And me, I'm like, I know this asset isn't worth what you're telling me. It's way upside down. I'm going to have to foreclose to wipe out the equity and all the mechanics liens that are behind your first lien. I'm only willing to offer this. And so it's back and forth. Eventually, especially at the end of the year, depending on how that bank's portfolio looks, if they got more non-performing stuff, every non-performing note costs them 10 to 20 times what they're making on the payments in leverage and being able to lend it out. So they're often motivated, especially as we get to the fourth quarter or the first quarter of the year, to get stuff off their books at a bigger discount. So that's just like, took 120 days with this guy going back and forth, and He finally settled on my 70 cents on the dollar, provided that I could fund before the end of the year. I'm like, yeah, dude, I'm ready to fund tomorrow. I've already done all my due diligence knowing we're going to sell this damn thing. So it's back and forth. Follow-up is key and everything. I mean, I'll give you a great example. Another one, lender sent me 10 notes on some multifamily stuff. I came in at 60 cents on the dollar. He came back, oh, no, you got to buy the whole thing at 90 cents, all or nothing. And I just laughed at him. I'm like, you're not going to sell this because there's like a 20 unit in New York City that's way upside down. Nobody wants to buy that stuff. Something in New Jersey, another crappy apartment in Chicago that looks like it was the fiveplex at time forgot. I'm like, you're not going to sell this all or nothing. You can want it. You can want one end and achieve the other. So it's just on my follow-up spot. I'll give you this one on that one. If you want me to buy it all or nothing, then I'm going to put a big buy for zero on the New York stuff because you can't give that stuff away right now. You know what I mean? So it's just follow-up like with anything else, and that's where most of the money is made is in the follow-up. I would probably say 50% of the deals that we've closed have all come 30 days after our bid was either declined or we weren't the highest bid, and then during the due diligence period, a previous buyer, another buyer fell out because they didn't like what they found and moved on. So this is like anything else. Just got to put your systems in place for follow-up.
And to piggyback off the due diligence process here, you mentioned a few things here. You're essentially playing the bank as you are underwriting the borrower in and of itself or themselves, looking at their probably their PFS and their payment history, things like that. Could you give us a little bit more of a peek behind the curtain on that due diligence process?
Yeah, exactly. So with anything, we're going to order a broker price opinion, having a realtor go out and give us a comps. What's its value is in current condition. That's the first thing. We're going to pull title, do a title report. We don't need to pull a full brand new title from creation of the property. We just go back to when the previous loan was originating. So it's usually like a 2-owner report we pull, or an ONE report. That's going to tell us what kind of stuff is owed on taxes and liens and stuff like that. It's an important thing. Of course, we'll check property taxes, the county, make sure those are paid up to date. And then it is getting literally in the spreadsheet with the servicing notes with the back and forth from the borrower to the seller. Most times you're not going to be able to actually call the seller and talk with them until you own the note. Because, I mean, sometimes you get permission, but that's why you look at the servicing notes, because the borrower will often tell the previous lender what they want to try to accomplish. I'd like to try to modify this, or I don't want to own this anymore. With rates going up, I can't refinance out. You know what I mean? I'm upside down because my interest rate went from 3 to 9%. So those are some things you can tell. And of course, you're going to get the original file, the original appraisal, like you said, the personal financial statements, what's going on with that stuff. And, if you're dealing directly with a bank, on times they'll tell you, like, hey, this borrower's got a great relationship with us, banking relationship with us. We don't want to foreclose, so we're willing to sell it to you so you can be the bad guy. I'm like, I don't mind being the bad guy because I'll come out the good guy after all. And so it's just going through that. You're going to have 30 to 60 to 90 days, depending on how big the asset is or how many assets you're buying. Sometimes you'll get up to 6 months. I mean, we all know commercial moves a little bit slower than residential stuff, so it takes a while to look at stuff. I mean, and I always joke, the hairier the asset, the bigger the discount. So the bigger the pain in the ass the borrower is, or how troubled it is, or what's going on with that property. I was looking at a note down in Corpus Christi, Texas. It was 150 units. Kind of a rough part of town. There was a fire, so 30 of the units were basically vacant, need to be completely rehabbed. That's something that I wouldn't have seen looking at a spreadsheet. I had to basically, drive down and take a look at it. But that came up during the due diligence process. And we approached the lender and said, listen, you didn't tell me that 30 of these units had caught fire. You know what I mean? I need to reduce my bid down. And they're all, well, we don't want to reduce that much. I'm like, well, then here you go. You can own this gang-ridden, burnt out apartment complex. No. Okay. All right. How big a discount do we need to give you now? I'm like, well, this is what you need to give us, and go from there.
So it sounds like a lot of times with these banks or lenders, I should say, they're just to get these underperforming assets off their books, they're willing to give a pretty good sized chunk of discount, right?
Yeah, it all depends on the lender, depends on where they're at in their portfolio. So if, like the banks, if you're feeling like a FDIC chartered bank, okay, there's about 5,000 licensed bank institutions out there. They've all got to submit a quarterly report to the FDIC. And on that quarterly report, it tells you how much in distress they have, how much of their residential portfolio is upside down, or how far behind on average, their portfolio is, or what percentage of the assets is compared to the overall lending amount. You get some banks that hold paper, it's worthless, right now. It's pretty sad that these banks are way upside down with the paper. So that gives you some sort of negotiation tactic. Like, hey, I know you got $700 million in non-performing debt right now. I can alleviate that by taking some of the stuff off your books, but you got to work with me on it. You know what I mean? And if you got dealing with a small one-off bank branch, they're not going to take too big a discount because they can't afford to. They just don't have the lending and the deposit relationships to do that. So we like to target that, five branches or more size. You could buy commercial stuff from like a Bank of America, Chase, or Citi, but they're usually going to have a independent separate department for that, not like the traditional bank. Like Wells Fargo has a thing called Wells Fargo Multifamily. And if you didn't read the quarterly reports, you wouldn't know it was there, right? So like walking into the Wells Fargo bank, I want to buy your notes. They're not going to know what the hell you're talking about, So that's why you got to speak the lingo. And I don't, you got to call and talk to the main corporate office most of the part and know, it's not that difficult. I always say it's kind of like waking up and going from being blind to now being able to see the world in a whole different picture. You know what I mean? Well, there's a lot of opportunities around here that I didn't think about beforehand. I just didn't know.
Gotcha. When you're actually purchasing the note from the lender, from the original lender, what does that process look like? Because usually when we're buying commercial real estate, it's a purchase contract, dot your I's, cross your T's, wire the money, you're good. What does that process look like on the note side? Do I'm sure there's a contract somewhere too, right?
Oh, no, we're just showing up with a box full of money. You know what I mean? Like a cocaine deal gone bad in Colombia, So we do our due diligence, collateral, all the banks provide collateral files, and then we wire money in. There's no like title company to close at because we're not changing title. Remember, the borrower is staying in place. We're not changing. We're just taking over the note. Now, if you're doing a sizable amount and you're funding with a company not funded, where you may use an attorney as like a mediary, set up an escrow account with them where you're wiring the money in. The bank sending over what's called an assignment of mortgage, which transfers docs or the assignment of leases or assignment of rents, And then that's what happens. Basically, money's wired, and then the assignment of mortgage shows up the next day. Now you're the lender. You go get that recorded, and then you take over. If they've already started the foreclosure process, then you're getting an assignment of counsel. You're just stepping into the bank's shoes and, either finishing the foreclosure or then reaching then out to the lender or the borrower and say, hey, I know you're facing foreclosure. Can you do anything? Or what's the story behind the story? And the overwhelming thing that's amazing is that I think the biggest opportunity right now, anywhere, bar none, is small balance commercial stuff. And by small balance, I mean like under $5 million for the most part. Because what happened in this whole recession thing is a lot of the local banks financed about 70% of the commercial stuff that was being bought and sold. Whereas in the previous recession, Wall Street was gobbling up everything, right? Well, now you've got, I call it Wall Street investments, but with Main Street funding. And so Main Street, the banks aren't in the property management spot, and they've got all this small balance stuff that Wall Street doesn't want to touch. But investors like you and me, that we have opportunities and know the lay of the land or the markets, or we have relationships, can really capitalize and take stuff over. And the nice thing too, it's different about buying a note versus buying a property a lot of times, is if it's like $1 million or more balance, the bank might very well finance your note purchase. So think about how crazy that is. Oh, we got a note, we don't want to own the property on, we're not getting paid on, but we'll technically finance you taking this off our hands at a discount, which is kind of weird, but it happens.
That's interesting. Very interesting. Can you loan me money so I can buy this non-performing loan?
They're not lending you money. Can you just bring 10 or 20% down, and we'll just basically set up this loan on the opposite side of the balance sheet so it offsets our loss.
That makes sense. So are there any immediate red flags that instantly make you just walk away from a note automatically? Like, nope, not touching it.
Yeah, I mean, the number one thing, and it's whether you're buying residential, commercial, never buy a note you don't want to end up owning, okay? So I don't like unfinished projects. I don't mind rehabbing stuff, but I do not want like unfinished projects. That's the worst thing. I don't want to go in there and try to track down, building permits and plans and all that stuff. That's not worth my time. I don't want that at all, okay? I prefer occupied assets. You know, that's always better than vacant assets. I wouldn't touch office building right now with a 10-foot pole if I was anybody out there. Multifamily, you got to be very, very careful on stuff like that. I mean, we just had this month in Houston alone, over 4,000 units go to foreclosure on over $1 billion in commercial debt from get this one property owner. Lost $1 billion portfolio. It's over like 5-6 properties. So multifamily's got some opportunities, but you got to make damn sure you're buying it right, and stuff like that. So those are things. The first one, ever buy now you don't want to end up owning. Second of all, if you don't want to foreclose, don't buy debt, because you got to foreclose at some point. You don't run a charity. I donate to them. And that's why you hire attorneys to handle the foreclosure process, to deal with that. You don't want to be in that, back and forth with a bar. Let your attorneys handle that, or your servicing company handle that. That's the thing. And then I think the best thing to do right off the bat is stay in areas when you're starting off that have populations. Don't deal in small towns until you're familiar. So like I grew up on the coast down by Corpus Christi in this little small town called Ingleside, Texas. Ingleside, Texas maybe has 9,000 people in there. Well, I think that's way too small a market for somebody right off the bat, unless you know that market, right? So stay in most of your, cities that have 25 or 50,000 or more, plenty more opportunities. It's easier to get stuff done in those bigger cities too. So, and then another thing is, always ask what's really going on with the asset, because the bank will tell you one thing, the borrower will tell you something else, and you've got to piece it in the middle to see what's really going on in a lot of cases.
The problem is you can't really talk to the borrowers in many cases until after you close the note, right?
Well,
so that's a big challenge.
The best thing, though, is payment history and servicing notes. So if you see that the borrower's not been calling in, you know that the borrower is a deadbeat kind of beat. You know what I mean? Because most of the time, responsible people are going to be calling the bank, hey, I'm trying to do this, or they're going to submit like a modification request or some sort of forbearance agreement. There's going to be notes and letters that back all that stuff up. If I don't see any of that stuff, I'm like, okay, this borrower is probably likely I'm going to have to foreclose on, especially if they're more than 12 months or 12 more months behind. You see what's happening right now. You see a lot of performing or mature defaults where the loan was for 3 years or 5 years, and that term has changed and the borrower's still paying on time. They just can't get refinanced out. I'm like, okay, well, that's not so bad. What can we buy it at, and what's their existing payment they're paying? Will that make good yield to us? Or if we have to adjust, recast the loan, is it going to be a good deal for us? But that's the thing is, commercial deal is its own kind of story in a lot of cases. Residential is pretty easy to turnkey a lot of stuff. Your commercial stuff, you just got to know what's going on with that asset, that borrower, and the marketplace too.
Sure thing. Can you share a couple of cool or creative ways you've done this note investing? Maybe something where, and I know I've learned that you can turn a non-performing note into a performing note by working with the borrower in some way, shape, or form, right? So, are there any other creative ways to structure a note, whether it be with the original lender or the borrower, or restructuring the note so that it becomes a performing note or profitable, if you will?
So I'll give you a story. I had a guy that came to me. He was an investor, a real estate. He didn't technically own. He had taken over a mixed-use self-storage facility in South Carolina. Okay, so he took it over subject to the existing financing. So his name was on the mortgage, but he was paying the mortgage and operating this property. The borrower kind of technically walked away, deeded it over to him. And so he was struggling to stay afloat. So he came to me. And I'm like, oh, yeah, okay. What bank is it with? And he goes, well, it's with Palmetto Bank. I'm like, oh, I know the asset manager at Palmetto Bank. So I call the asset manager up and say, hey, you got any commercial notes you're looking to sell? And sure enough, he sends me this list of 20 notes. And guess what's on that note? This one self-storage mixed use spot. So I said, oh, okay, what do you want for it? They want like 70 cents on the dollar. And I went back to technically the borrower on this. I said, listen, here's what they're willing to sell the note for. Can you raise capital to buy your note out? And he could do that. He had some investors that would fund him at a lower rate. And so that's what happened, is we basically brokered the purchase of his own note. Now, the bank would have never sold it to him if it was the same borrower name or the same person on the LLC. So it was completely through a different attorney, right? Sold it. And the attorney office was representing investors that immediately just did a quick, basically refinance, and forgave 30% of the balance on that note because they were pretty excited about being in business with the guy. And suddenly, this guy's business went from being basically right on the red area to being fully in the black. And so gave him the extra money to get it leased up, to do a little bit of work, and now it's, I think he refinanced out 2 or 3 years later with the investors, and they were all happy and stuff like that. That's one kind of cool thing. We bought a here in Austin, Texas, years ago when the most creative deals that we did was a 24-unit, it was an apartment complex next to the University of Texas Law School. All right. And the great thing, they were all kind of individually metered. Well, it needed a lot of work. So the bank came to us and was willing to say, hey, we can't rehab this property, but we know you can do this. If we finance you the note and the rehab costs, would you go and rehab it and help us sell it off? We're like, you're going to give us the money to rehab this and basically give us the price at a great price. Like, yeah, we'll do that all day. We just want to get this off the books. So that's what we did. We went in, instead of actually converting it we took it from an apartment complex, we condo converted it to individual units, okay, which raised the value per door up to basically $100,000 a door versus like $40,000, $50,000 a door. And we rehabbed them. But what we did is that we went out to all the tenants who'd been there, or people that were coming in and say, hey, here's an opportunity for you to buy a condo for your students for 4 years. Because if you're going to law school, you usually got pretty good parents that do stuff. So we allowed the parents to go sign. So we originated the paper and then sold the paper off. Got really creative with it, held the seconds in an IRA, but made a ton of money. The bank was happy because they were able to get out of a bad unit to bad property. And you'll see that sometimes, literally, like the Bank of Synovus, which is out of like Georgia, and they have like, I don't know, 10 different banking relationships. They literally will say on their loan sale agreement when you submit your bid in, if you want to joint venture with us, tell us what you have in mind. We may consider it. So that's a little bit different on the commercial, because you won't ever have them do that on a residential note, though. You know what I mean?
I feel like more banks should be more creative like this. This is awesome.
They do. More banks are having to, especially in the multifamily. We just saw a bank up out of Dallas foreclose 2 months ago on three big apartment complexes that were all part of the Tides group. I don't know if you've heard what's going on with them. They're losing like 2,000 units across the country. So they didn't want to foreclose. They didn't want to sell the note at a discount because there was all these liens behind it. So they foreclosed, which cleaned out the title. And they're planning on holding these. And they partnered with another apartment investor who they'd finance some stuff to and say, hey, come on, manage the stuff for us. We'll partner on this, and we'll split profits and sale proceeds, what we sell it after 3 years after we regentrify the asset. So that was kind of a unique thing as well. Neat. But you know what I mean? So that's the thing is, it's all about relationships, networking, local mortgage bankers associations, the Chamber of Commerce, that kind of stuff, any servicing conferences. I mean, just talk and find out what's going on with the asset. That's one of the best conversations. Banks will lie to you and tell you they don't have anything non-performing. I was out in Baltimore at a networking event speaking, actually, and a guy came to me, you could call, I got a bank out here who's got a non-performing note on like a 40-unit apartment complex. I'm like, oh, really? Okay. I said, what's his name and number? And he's like, oh, so they gave me a name. So I called the bank asset manager up, and he's like, oh, no, we don't have anything. And I sat there for a second. I said, so you don't have any non-performing notes at all? Nothing. And I had his quarterly report pulled up. I said, well, I see right now that you've got about $6.5 million in non-performing stuff that's beyond 120 days late. And I happen to know about a 40-unit apartment complex located at 123 Main Street that's in default and going to foreclosure. And you could hear a pin drop on the other line. He's like, hang on a second. Let me put you on hold.
Called him out. I like it.
You have to call him out. I mean, I don't have any non-performance. Bullshit, you do. Every bank does. Now, they may not always want to sell it, but yeah, every bank out there has something non-performing, especially in this market.
Have you ever done like a modification of a loan? I know you mentioned recasting earlier. Have you done anything like that while you're in the purchase of purchasing a note in order to?
No, you can't adjust it before you own it. I mean, if you recast, there'd be no reason for the lender to sell the note. They would just do it overnight. A chunk of them don't want. Once they get to the point where they don't want the paper, they don't want the paper. But a lot of times they may have tried to work that out originally at specific one point. Because when you're actually the originator, you're kind of tied into it in a lot of cases, And once you decide to take a loss, you've got to write that debt off your books. You get a whole lot more flexible on it. But that's the thing is, if I'm into it at 50 cents a dollar, I can be a lot more flexible than somebody who's into it at 95 cents of the dollar, 80 cents of the dollar. That's why you're starting to see more and more banks, especially probably the last 3 years. If you were doing a commercial mortgage with them, they want you to have a deposit relationship with them. You've got to bring over the deposits. We want the deposits to go in there because that kind of offsets, they're okay, we'll give it to you at 80 cents a dollar, but we got the deposit relationship. So technically we're at 70, 60. We need to be. So just see what's going on. I mean, if it's an ugly asset, it's an ugly asset. I had Capital One send me a list, or actually Amy, my asset manager over there, she called me, hey, Scott, I got a 73-unit apartment complex in Miami that fell out. Would you want it? I'm like, yeah, it's mine. Viva la Miami. He goes, well, it's kind of a rough spot. I'm like, well, okay. Give me 24 hours. So I called my realtor, Osmani, down there. He drove by and took some photos. He called me back. He goes, man, this place is rough. It is like ghetto fab rough. Like all the crackheads were posing. They were like doing something like out of the Dave Chappelle show, doing the whole robot while everybody was walking by. So I send the photos over to Amy, and my phone rings about 10 minutes later, and I can hear her laughing and other people laughing. And she's like, what do we have to pay you to buy this note from us? And I'm like, well, nothing, because I don't want it. You know what I mean? I don't want it. You're going to have it, and, you better just end up writing off your books and then letting somebody else get it from or pay somebody to deal with it. But it's just, you see stuff like that, and some stuff that's been around for a while doesn't help anything. You want to be active. I've seen people buy notes and then they weren't familiar with it and they let it sit on their books for 6 to 12 months. And by the time they get around to it, it's gone to tax foreclosure, been wiped out. So you got to double check the stuff like you do in residential stuff as well.
Now, you mentioned a few tips and tactics that you do, and the biggest moral of the story here is networking with the banks, right? What is your secret sauce to maintaining that relationship with them? Do you follow up with them, or what does that look like?
Great question. And this is probably the biggest mistake all real estate investors do is lack of follow-up. So for 13, 14 years now, I've been sending out an email once a month to my list of asset managers. And it's always, hey, what do you have in your books you're looking to get rid of? You know what I mean? And it's just the same thing. I've had people tell me it's the green email because green is my favorite color. I mean, I've got a green screen behind me, but usually it's usually a black brick wall for using something else to do this. But it's just touch and base. Hey, what do you have in your books this month? What do you have in your books this quarter? What are you looking to get rid of? Asking for referrals. Hey, do you know somebody? Because most of these asset managers are networking at the local Mortgage Bankers Association, and they know what's going on at fellow banks. So it's a good relationship aspect, but it's just literally taking that contacts, putting it into a CRM, an email, something, and just sending an email out. When you look at less than 48% of all salespeople follow up with more than one email, that should tell you right there. And, sales, 80% of sales comes after the 5th contact. So that's what we try to do is email, LinkedIn connection, phone call. Sometimes we'll make 50 to 100 phone calls a day. That's how I used to start doing things. I don't have to do that much anymore. But just touch base. Hey, what do you have in your books this month? You don't have anything this month. When do you think you'll have something? No, next quarter. You mind if I follow up with you next quarter? And just doing that. There's systems with text messaging or email or other things that can come in really handy as well to do. And so we've just put those systems in place and just follow. But we're also always looking at new stuff too. I mean, people say, oh, there's no note deals. Look, there's not as many note investors out there as there are other people. And all banks won't sell to you because you're too small. That's a bunch of bullshit. If this Ingle-Dink from Ingleside, Texas can get banks like Capital One, others sending me notes to take a look at, you guys can do it too, because most of you out there listening are probably smarter than me.
Love that. Love that. Let's talk about funding for a little bit. You've done over $1 billion of debt that you've purchased. What does funding look like? Do you raise capital? Do you purchase it yourself? JVs? What is it?
Kind of really all of the above. It depends on the asset. If we have one investor that can, the first thing, let me take it back. We'll always ask the bank, hey, on the commercial side, hey, are you willing to carry any of this debt for a period of time? 12, 24, 36 months if we bring in 10 to 20% down. Sometimes we've gotten with zero down payment where they just like, we want this. We just don't want the responsibility for it. We'll finance it to you, which is great. So if we've got to bring some down, then we're talking to investors. If we're always constantly raising capital. So if it's like I said, if it's a small amount, 250 to 500, we're buying it. We usually get one or two investors that'll come in and we'll put them in an LLC and we'll raise funds. If it's going to be something, a bigger pool like we're starting to put together now, it's a fund process of raising capital that way. So, it just depends on the asset. If it's a one-off deal and we get one investor to fund the deal, that always works better, Makes a whole lot less headaches, but then also some of the bigger stuff we bought, especially for the pools or the residential stuff, we will fund with a fund.
Do you have different pools in your funds for residential versus commercial?
Yep.
Okay,
Yeah, because
gotcha.
they're completely different asset classes. You know what I mean? So you should have separate LLCs and separate entities for your portfolio too, besides just what you're funding. You know what I mean?
Now, whether it be a one-off or whether it be within a fund, how are you structuring that with your LPs in terms of the returns that they are getting and what the
So if it's just
GPs are getting?
so if it's just one investor, and depending on the situation, it all defines on it's about what they're doing. So if I'll give you an example. So if we get an investor that comes to us who's been very passive, their money's been sitting in an IRA account, not making anything, and it's a one-off asset they're going to fund, we'll give them 8%, 8 to 10%, because their money's sitting there making nothing, right? But now if I got somebody a little bit more savvy like you come to me and say, well, I got $500,000, but I want bigger balls than 8%. Okay, well, we buy an asset, we'll go 50-50. We'll create an LLC together. I own 51%, you own 49%. That allows us to legally split the profits down the middle that way. All right. So if it's a fund, then it's going to be basically an 8 to 10% pref with 25 to 50% of the back end, depending on the portfolio of the asset that we're dealing with.
Gotcha. Now, do the investors, and I'm sure these guys that are LPs in the fund that are probably larger funds, they understand how notes work and they understand that there's a risk of taking over or foreclosing on the asset and taking over the asset, right? So they understand that you might not always get a dividend or a preferred
Yeah.
return
Well, that's
until
the
the
thing is
sale.
that's a very good. That's how we basically structured a lot of stuff. Like, listen, if the borrower's not paying, we're not going to be paying out dividends until these borrowers start paying it, or we take the asset back and foreclose. So we always outline that in the front end. That's why we had to start teaching workshops, was teaching people the difference between buying a note versus buying a property. You know what I mean? And so that's why we've got the podcast. That's why we go through, because buying it, this is different. Just because I bought that note doesn't mean I own that apartment complex, doesn't mean I'm the landlord now, rolling in rentals. You know what I mean? It's a process of going through that. And that's one of the things, like I said, it's just educating them. Hey, this could be a 12 to 24 month process before we get a dime in on foreclosing. But the fact is that we're buying it at such a good price. If they start paying, great, we'll start paying quarterly. If they don't pay and we got to foreclose, it's still going to come out good. You just got to be prepared for that.
What has been your worst performing note versus your best performing note?
Worst is anything I bought in Chicago. I bought a 10-unit apartment complex in, as I call it, Crook County, Chirac. It was 10 units and it had 4 mixed units of office, retail on the bottom. And we bought this asset plus 10 others from a hard money lender back in the day. And they'd finance it 70 cents on the dollar. And we were buying it at 49 cents of what they'd finance. So I was like, we're buying this at like 37 cents on the dollar. Woo! Have you ever had to foreclose in Chicago? It is not a pleasant process.
I try to avoid Chicago.
Yeah. I've been there. I lost probably about $500,000 on that deal because it took forever to foreclose. Evicting people was horrible to do. They break out and break back in. We had one unit we walked into because we didn't get to see any units before we bought it. I went and walked it, but almost got shot at. I should probably have been the sign not to buy that. But when we walked in, the hot water was on. It had been running who knows how long because the entire wall was just coated in black mold. The tenant below basically had water and sewage running straight down into her bathtub from the unit above. It was just a shit show. So
shit.
Literally, Ron LeGrand likes to say that the smell of shit and piss is the smell of money. Yeah, it's the smell of money either coming in or going out. In this case, it was going out. So do not buy there. No offense. If you live there, it's a different story because the judges will side with you because you're a voter. But since you're a big, bad out-of-state investor, they don't like to side with you. I got evicted the guy 3 times, and the judge kept giving him like extensions after extensions after sections. I'm like, come on. I finally had to assume in federal court to usurp the Chicago stupid judge, but we were able to do that.
God.
Yeah, that's the worst one. I mean, we've done some interesting ones. Like I wholesaled a 16 unit in LA for a quick $100,000 profit years ago in like 2 weeks. That was really a nice day, and then we bought, like I said, a 300 unit in Indianapolis from Banco Popular back in the day that I didn't have to operate it, but I got a 20% of the profits, which is pretty good because we regentrified it and sold it off 2 years later. So it's just, I like singles and doubles. I like it where we can buy and then we can get a 12 to 20% return on cash flow. That's a great day. That's a
And,
really great day. You know,
and those are probably your average return notes.
yeah, if we're going to buy something, we're going to take the cash flow. We want to see a 15 to 16 yield or greater. That's why, because if we're giving away an 8 pref, that's what we want to make sure of that. And then if we know we're going to foreclose, we're going to want to see at least a 20 to 25% return if we have to foreclose and either sell the asset off, do a deed in lieu, or foreclose. Now, usually if we're going to foreclose and then take it back, it's going to be higher than that because we're usually buying it at a price. So we can then count on the appreciation or the true valuation of the property, not just what's owed on the note.
I love that. Well, Scott, I learned a ton today. I had a blast today. I'm gonna have to re-listen to this episode to get my bearings back into place. You know what I mean?
It was an all-you-can-eat wonton wealth mega fest today. Like going to your freaking buffet. Well, always glad to help here. I mean, that's the thing is that, look, I've done this for 15, 16 years. I love what you're doing with the podcast. You're doing a phenomenal job. And once again, everybody, if you're listening here, we as podcasters love to hear from you. So make sure you hit the subscribe button, leave a 5-star review. We'd love to see that. But look, we've got kind of a cool thing we started doing a couple years back. We've got a free, 3-hour course. It's a 1-day kind of dip your toe in the water and learn about how we find these, we fund them, and how we flip them. And that's free to anybody that's interested in sign up for it. You just go to noteweekend.com, and that's a good kind of our Cliff Notes version of our a bigger class. We buy a lot of residential stuff. Residential is pretty easy. Commercial, if you're going to buy commercial notes, you got to understand that each asset class is different, and learning how to underwrite an apartment is different from a self-storage unit. It's different from a mixed use, and then comparing that to how you're underwriting the note. So just keep that in mind. But it always pays to be the bank. I like to say it's the sexy side of real estate. I don't care if you're brand new, if you've got no money. A lot of private capital out there to fund deals these days. So I'm very excited what the next 24 to 36 months are going to hold for us in the distressed debt space.
And now, before you leave us, Scott, give us a handoff on where that people can find you aside from your website. I know you have a podcast as well. Just throw out all your stuff, and I'll put them in the show notes.
Yeah, so we just released our 1000th episode of the Note Closer Show podcast. Been doing it for about 8 years, and 1.5 million downloads, something like that. But our main website's weclosenotes.com. If you go there, you can actually see our classes and book a call with me. And we also, too, this is kind of a cool thing. We just launched the first ever note clone, as we like to talk. So we took our thousands of videos and thousands of articles and blogs and uploaded it all into an AI clone. And now that AI clone can answer questions on your real estate note deals 24-hour a day, 7-day a week. And you can go to our website and click on it and start asking Scott Clone questions and go from there.
Love that. Are you on any social media platforms?
Yeah, I'm on one Scott Carson, just about everything. So not the soccer player from England. That's where on Facebook I get tagged for him. I think I'm better looking than that guy. But anyway, but on all social media, it's usually at one Scott Carson on Instagram, Facebook, LinkedIn, all those, Twitter as well.
Phenomenal. Scott, appreciate your time, brother.
Thank you for having me, man. Been honored to be here. Appreciate it.